Hey guys, Ricky here. So I'm going to be covering the 4 things you have to know before qualifying for a home mortgage. So you may have heard that recently the interest rates are low. If you haven't already, that's historically low. And also a lot of people are looking to buy. If you're one of those people, this is the video you want to watch. Let's get to it. Number 1, it's going to be income. They want to know how much you're making and how long you've been making that for. What that means is if you're a W-2 worker, they will take a look at your gross income. So if you're currently making a certain amount, they will take that as your current income. However, if your income has declined over time, they're going to take worst case scenario. Think about it this way. If you let your friend borrow some money, you're going to look at what they're earning to see if they can even pay you that money back. It's no different for the banks. They are trying to determine your ability to repay the loan. Now, when it comes to income as far as self-employment, it's treated a little bit different. They will be looking at the net after expenses, and you want to make sure that you're ready for that when it comes to applying for the mortgage. Number 2 is going to be how much down payment do you have for the transaction. This could be as low as 3%, 3.5%, 5%, 10%, 20%, you name it. At the end of the day, the more down payment you have, the stronger of a buyer you are. So it helps you qualify for the mortgage a lot easier. And the reason why is we just spoke about income. The other factor is going to be your debt to income ratio, which is determining what your monthly income is and your monthly obligations are. That gives us a percentage, and that percentage will help determine what loan program you qualify for and what's the max you can qualify for. Thirdly, it's going to be your credit score. That's right, guys. If you haven't checked your 3-digit code recently, that you want to keep an eye on this number. This is one of the numbers that you hear all the time, right? Hey, check your FICO score. What's your FICO score? But when have you taken time to actually look at it? Plan ahead, guys. When it comes to qualifying for a mortgage, you want to be prepared. So check that number, ensure that you're making your payments. And I actually made a video on what determines your FICO score. So if you want to check it out, I will link it here below. You'll be able to check it out. Also, keep in mind, guys, that when it comes to the FICO score, the higher your FICO score, the better terms you can get. And I'll tell you why. Because the higher your FICO score, the bank sees you as a more responsible borrower, giving you better benefits. So if you're looking for a first-time home buyer, typically this FHA, they're a lot more lenient when it comes to the credit score. You could actually get something as low as 620 FICO score. Now, when it comes to conventional loans, you want to have a minimum of 680 FICO score. This is very important. And just to note, the Tri-Merge credit report is the one that's used when determining your FICO score. The bank will actually use the mid score. So if you ever have Experian, TransUnion, and Equifax, you want to see what the mid score is, and that's the score that will be used for qualifying you for a mortgage. The 4th thing you want to know is the property or home that you are looking to purchase. It's very important to understand when qualifying for a mortgage, the bank will only let you borrow as much as the home is worth. In today's market, we're seeing this happen oftentimes where appraisal contingencies are being removed. What does that mean to you is that if you're in a home transaction and you've removed the appraisal contingency, that means if the property comes valued less when the appraiser goes out, you are in charge of paying that difference. So you want to ensure that you have those funds secured before offering more. Also, if the property value is less, the bank is not going to let you borrow more than what it's worth. So it's important to understand that. Another thing that comes in hand with that is understanding the loan limits. There are certain loan limits in certain counties, and you want to make sure that you are below that to get the best terms. Overall, just to recap what you want to know for qualifying is it's important to understand that your monthly income and your monthly expenses will give a debt to income ratio, and that altogether will come with your FICO score and the amount of down payment you're bringing in. That all those factors determine what your qualification will be. So you want to ensure that all these things are in line before you start the process. And if not, I'm always open to answer questions. You can reach out to me, and I'll have links below on the video I referred to earlier, which was the credit score. Thank you for watching. Subscribe and like.